Welcome back. In this quick lesson, I'm going to talk about how to retire tax-free using the tax code for income tax purposes. There's multiple ways to do this. This is just one strategy. It's not a prescription. It's just to show you how a lot of the wealthy people set up their cash flow so that they can avoid future income taxes and maximize the cash flow while they're alive. Personally, I like the idea of having control over my money and not leaving too much of it subject to market volatility or the whims of the government and whatever they want to charge in future tax rates. So to me, this is a very conservative way to maximize cash flow, take care of my family, and keep control. Let's dive right in. All right, how to retire tax-free. And we're going to use the same foundation account that we set up, or we've been talking about this entire course series. We're going to use that same illustration we looked at earlier for the 45-year-old standard male, and we're going to use that exact policy that we've used as our bank our entire working career to minimize opportunity cost, to maximize rates of return, to maximize control and outside business investments, whatever I want to do with that money, and how it won't offset my retirement cash flow. The younger you are, the better this looks. But I literally have people in their 60s that set these accounts up so they can have cash flow in retirement exempt from taxation. So for a 45-year-old, this is going to look really attractive. I have 20 years before I quote unquote retire. I can retire sooner if I wanted to. In this example, I'm just going to age 65 to keep it consistent with everything we've talked about so far. So remember that number on the bottom, 1.17 million. That number has never changed, regardless if I'm pulling money in and out of the policy. And that's because of that non-direct recognition, which I find magical when it comes to life insurance. That 1.1705 is actually the cash value inside the policy that I could use for retirement. Your life insurance can be used as your retirement strategy. So if we look at the same policy, okay, if I changed the screen so you can read this. There's my 1.17 million in cash value at age 65. And you'll notice, see the age here? It goes from 65 down to age 90. We're talking about a 45-year timeline. Yes, this is going to look different. No, this is not all guaranteed. There are guarantees inside of this, a lot more than most investments, because this isn't an investment. This is life insurance. So there are guarantees in the contract. But with today's rates, I'm doing a projection from age 65 to age 90. Those are the retirement years, right? After I stop working, whether it's 60 or 65, in this example, 65, when I'm done working, I don't want to be putting money into a life insurance contract. Now, this is one of the biggest misconceptions. People say whole life, oh, that means you have to pay premiums your whole life. No, you don't. I can stop whenever I want. Personally, my contracts are guaranteed to stop at age 65. That's the way I set it up. So I stop putting money in at age 65, and what happens at age 66? So at age 66, I don't want to be putting money into this policy anymore. I want to be living on it. So I call the insurance company and say, hey, look, you're in the hook for over $2 million of death benefit. I'd like to borrow some money. Now, this is a static PDF. It's not an interactive, file or anything. So I just told the system, hey, what amount of money can I pull out or can I borrow against the policy to age 90 and make sure that the policy still stays in force? And that's where they came up with this goofy number, the 66,000, call it 67,000, 67,000 a year. So the insurance company gives me a $67,000 check. That is cash flow. It's not ordinary income. It's not even growth of an asset. It's considered cash flow. When I look at how much money is coming out of this policy, that's $67,000 a year. No market volatility, no 1099, no asset manager fee. That's pretty powerful stuff. Now, what's the cost? The death benefit gets reduced. So look at age 72, for example. If I passed away at age 72, I've taken all this money out, I still leave a death benefit of 1.5 million to my family or the estate. Income tax free. Now, if I do some math here, 67,000 or 66,927 for 25 years, I'm pulling money out of this thing for 25 years. How much money have I taken out? over $1.6 million. $1.6 million in cash flow off the radar screen of the IRS for income tax purposes, with consistency, predictability, no market volatility. I know that I can take care of my family. And in this example, age 85, if I died at 85, my family still gets $628,000 in income tax-free death benefit. Now, in the example, from age 45 to 65, I put in $860,000 in cash. That was my total cumulative premium over my working career. In retirement, I took out over 1.6. I took out twice the amount that I put in. So technically there's growth there, right? The reason this is not income taxable is the same reason why debt isn't taxable in America. If I borrowed against my house and did a reverse mortgage in retirement, which people have a lot of opinions about this, I don't understand why. It can be a great tool. But if I had my house pay me cash flow, technically I'm going into debt. There's no tax due on the debt. And in this example, the debt is against the death benefit. I'm borrowing against a future benefit to my family. All of it's tax-free, even the benefit to the family. I have no market volatility, no tax bill. Literally, there's nowhere to put that cash flow on your tax return, like nowhere. No ongoing fees. I have a long-term care benefit built into the policy. If I get sick and need to go to a home, the insurance company will help pay for that. I have a death benefit for my family, and I'm able to use that money for anything in retirement. So I'm showing you a linear, $67,000 a year coming out. If I wanted to take out more, I can. At age 70, I have $1 million still in cash value. I could pull out a lot more than just 67. What we find in retirement is usually the earlier years, people like to spend a little bit more because they want to go on vacation, see the grandkids, things like that. And then as they get older, up into their late 70s, 80s, they might start spending a little bit less. But in this example, I've taken out twice as much as what I put in, no tax, and still leave a benefit for the fam. So the question is, how much would you need in like a 401k or traditional plan to duplicate the after-tax cash flow that life insurance can give you? You're going to be amazed. I've worked with a CPA for years. He's written a couple of books on this topic. He calls it capital equivalent value. How much capital do I need to equal the cash flow that a life insurance contract can give me? So in the next video, I'm going to dive into some numbers and give you a couple of calculations so that you can understand how much money you actually need elsewhere to duplicate the cash flow. So not only can life insurance give you the control of your money, get away from the market, get away from the IRS, give your family the death benefit, you have cash that you can use before retirement years, and if you're lucky enough to live through retirement, you have cash flow that the IRS can't take. And how much would you need in a 401k to duplicate all this? Check out the next video called Capital Equivalent Value, and we'll dive right in. If you have any questions, make sure you leave them in the comments below, and we will do our best to get those answered as soon as possible. Again, if you want to schedule a call to see how this looks for you, click that schedule a call button in the description. Thanks, and we'll see you in the next video.